Well, let's talk to Jim Paulson, who's the chief investment strategist at Wells Capital Management, and he's known for being more bullish on markets, and he's here to share his thoughts today. Jim helps oversee $375 billion in assets under management. He joins us from Minneapolis. Good to see you, Jim. We just talked to a few bears before we got to you. You know, you just heard from Stephen Roach, et cetera, saying that this is just money printing, and really you're not solving the issue right now of the debt crisis, the sovereign debt crisis, and the fundamental problems in Europe.
Well, you know, Susan, I guess I've always felt that this crisis is less about fundamental bad debts than it is about fear. And, you know, the debt ratio, even when this started in Greece, was not, debt to GDP was not that much higher than it was for the previous 10 or 15 years, going back to the early 1990s. What changed was the mindset around that. And what they did effectively was driving up the CDS rates, credit default swaps, up to, you know, almost 20% at one point, effectively making it Greece unable to raise any kind of money whatsoever in the markets, makes them technically insolvent. But I think, you know, what this does, a $1 trillion backdrop, if you will, or almost a $1 trillion backdrop, is it just provides the liquidity that they need, and now they're functioning again as taxing sovereigns. And I really think this will go a long ways towards putting this thing in the backdrop. Now, maybe down the road we're going to come up back to this issue a little bit, but I think this removes the imminent risk from the European crisis and allows the globe as a whole, and U.S. investors in particular, to refocus on a really good emerging fundamental story where both the economic and earnings momentum about the globe continue to accelerate. I mean, also lost in Friday's morass of Armageddon fears was the fact that we reported a very good jobs report here in the States, kind of completing the cycle of a self-sustaining economic recovery here. And I think over time that's going to take on more prominence in investors' minds.
Yeah, Jim, how do you make sense of these markets? Some are calling dysfunctional, especially if you have a 1,000-point drop one day, then you have a 500 points rally the next. I mean, what are you doing with your money these days? What are you advising clients to do?
Well, I got to admit, Susan, that type of volatility that we experienced last week is frightening. I do see elements of a dysfunctional securities markets here, markets where prices are leaving the fundamentals, if you will, and going off on their own, and doing it ferociously and by, you know, large amounts very quickly. If that continues, if we don't slow that down and keep pricing action closer to fundamentals, which probably change more slowly, then we're going to scare a lot of investors out of this market. If it becomes nothing but just a random dice throw rather than based upon the earnings fundamentals of companies, then you're going to see less and less liquidity in these markets. So I'm hoping that we find out what caused that and that we deal with it over time and slow those type of days down.
Yeah, I think investors agree with you. Let's find out what happened there. In fact, we had the exchange of presidents and CEOs gathering in New York to figure out exactly what just happened. But Jim, before we go, let me just ask you something. You say you're going to continue to stay towards risk right now. What does that mean? You're going long on shares?
Well, I think investors, I think when we're all done with this, you know, tonight we're 5% above old record highs here since the recovery started in the States. And this looks more and more like a refreshing pause in an ongoing recovery rally where markets pricing has been refreshed by 5 or 6%. Earnings over this period have gone up higher. Bullishness has been checked. The competitive long bond yield has been dropped. Oil prices have been brought down again. So I think it gives the investors an opportunity to tilt towards the risk parts of this market or the economically sensitive parts of this market if they haven't done so. Whether that's go a little more towards the stock market in general, whether it's to go to the more economically sensitive sectors of the market, or things that tend to be more cyclical, like emerging markets or small cap stocks, if they haven't been there. So I think that's what I think this is doing, is giving individual investors an opportunity to either get into this market or to increase their risk exposure here in a pause in an ongoing cyclical recovery.
Jim, a pleasure. Thank you so much for your time.